Why do interest rates have such a significant impact on financial markets? Interest rates play a pivotal role in the functioning of financial markets and the broader economy, influencing various aspects of borrowing, lending, investment, consumption, and monetary policy. Their significance stems from their direct and indirect impacts on economic activity, asset prices, inflation, and central bank policy decisions. Let's explore why interest rates have such a profound impact on financial markets. Interest rates determine the cost of borrowing for individuals, businesses, and governments. Lower interest rates make borrowing cheaper, stimulating investment, consumption, and economic growth. Conversely, higher interest rates increase borrowing costs, potentially dampening economic activity. Interest rates also influence the returns lenders receive on their investments. Higher interest rates typically translate to higher returns on savings accounts, bonds, and other fixed-income securities, incentivizing saving and investment. Conversely, lower interest rates may discourage saving and encourage riskier investments seeking higher yields. Interest rates affect investment decisions by altering the cost of capital. Lower interest rates reduce the cost of financing investment projects, encouraging businesses to expand, invest in new equipment, and undertake capital-intensive projects. Higher interest rates, on the other hand, may constrain investment by increasing borrowing costs and reducing expected returns. Changes in interest rates also impact consumer behavior. Lower interest rates reduce the cost of borrowing for purchases such as homes, automobiles, and consumer durables, stimulating consumption. Conversely, higher interest rates may discourage borrowing and lead to reduced consumer spending. Interest rates have an inverse relationship with bond prices. When interest rates rise, bond prices fall, and vice versa. This relationship occurs because existing bonds with lower coupon rates become less attractive compared to newly issued bonds offering higher yields. Interest rates indirectly influence equity prices through their impact on corporate earnings and discount rates. Lower interest rates reduce borrowing costs for businesses, potentially boosting corporate earnings and supporting higher stock valuations. Conversely, higher interest rates may increase borrowing costs and discount rates, exerting downward pressure on equity prices. Central banks use interest rates as a tool to achieve their monetary policy objectives, including price stability and maximum employment. Central banks may raise interest rates to control inflation and cool overheating economies, or lower interest rates to stimulate economic activity during periods of weak growth or deflationary pressures. Changes in interest rates can influence inflation expectations among consumers, businesses, and investors. Lower interest rates may signal accommodative monetary policy and lead to higher inflation expectations, while higher interest rates may signal tighter monetary policy and lower inflation expectations. Why do interest rates matter to financial markets? Interest rates influence borrowing costs, investment decisions, and asset prices, making them a critical factor for financial markets and the broader economy. How do changes in interest rates affect borrowing and lending? Lower interest rates make borrowing cheaper, stimulating borrowing and investment. Conversely, higher interest rates increase borrowing costs, potentially dampening economic activity. What impact do interest rates have on investment and consumption? Lower interest rates reduce the cost of capital, encouraging investment and consumption. Conversely, higher interest rates may constrain investment and reduce consumer spending. Why do changes in interest rates affect asset prices? Interest rates influence bond prices and equity valuations. Rising interest rates can decrease bond prices and may exert downward pressure on equity prices, while falling rates may have the opposite effect. How do interest rates influence central bank policy and inflation expectations? Central banks use interest rates to achieve monetary policy objectives. Changes in interest rates can affect inflation expectations, with lower rates potentially leading to higher inflation expectations and vice versa. Like the video and remember to subscribe to our channel.